Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Well, as you know, the jobs report this morning, we got it at 8:30 a.m. Wall Street time. U.S. hiring slowed markedly in the month of July. The unemployment rate rising to the highest level in nearly 3 years. It does suggest a faster deterioration in the U.S. labor market than previously thought and puts the Fed solidly on a path to cutting rates in September. Now, the rise in the jobless rate triggering a famous recession indicator. It's known as the Sahm rule, which has a perfect track record over the past half century. The mastermind behind the gauge, former Fed economist Claudia Sahm, who said on Bloomberg Radio with Surveillance's Tom Keene right after the report that while the U.S. isn't in a recession, we're not headed in a good direction.
Claudia Sahm, I've got to ask the media question. Is the Sahm rule in force at this moment?
It triggered. Yeah.
Wow.
Yeah, so that puts it up over its 0.5 percentage point threshold, noting that comes off of historical experience. That doesn't necessarily tell us where, we are right at this moment, saying a recession. This has seen way too much momentum in the unemployment rate in recent months. 4.3%, right? This is not, so whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market.
All right, that's Claudia Sahm with Bloomberg's Tom Keene earlier on Bloomberg Surveillance. I believe Damian Sassower also there. Meantime, the report further escalated. The bond market rally drove futures traders to price in expectations that the central bank will cut its benchmark rate by a full percentage point by the end of the year. There are other folks on Wall Street talking about several cuts, bigger cuts. So let's get to it and our deep dive on the jobs report and the move in U.S. Treasuries. With us, Bloomberg News international economics and policy correspondent Michael McKee right here in studio. Ira Jersey, Bloomberg Intelligence chief U.S. rate strategist out there in BI headquarters in Princeton, New Jersey, and Anna Wong, Bloomberg economics chief U.S. economist in Washington, D.C. Mike, I want to start with you. Lay it out for us how this morning's report compares to the data that we've been getting on the labor market. And I'm curious, as an economist, how you factor in the Sahm rule.
Well, let's start with the data. It's basically a continuation of what we've been seeing, a slowing economy and a slowing labor market, except that it went much farther, much faster in 1 month than perhaps the Fed was anticipating. If you ratchet it down to 114,000 over the last couple of months, Fed would have been perfectly happy with that. It's kind of a neutral level. 4.3% is still a low, historically low unemployment rate. And we also saw average hourly earnings ease up a little bit, taking some of the inflation pressure out of the numbers. So under other circumstances, the Fed might have said this is okay. And obviously, we talked to Austin Goolsbee, the Chicago Fed president, earlier, who said we're not going to panic over one number. We're going to take a look at what else is happening in the economy. And that's going to be the question from here is, what else is happening in the economy? What other numbers and how do they show up during the month ahead?
Shoulda, woulda, coulda, Mike. I'm wondering if Jay Powell would have had access to these figures. The Federal Reserve Board had a time machine and knew what was coming in the July payrolls report starting on Tuesday. Would they have made a different decision at their meeting, do you think?
Possibly. It's hard to know. It's really one of those situations where you can't know the counterfactual. I did talk to a number of open market committee members since the meeting, and they all acknowledged that Friday was going to be a risk-on event for them, and the risk came true. Now, does it mean the economy is falling off a cliff or going into recession, or does it just mean that we hit an air pocket? That's the part that they're not going to know, and that's where the Fed is going to fall back, what the Fed's going to fall back on and say, we can't just cut rates 50 basis points or intermeeting based on this one data point. And the Sahm rule, if you take it out to 3 decimal places, the unemployment rate, we didn't quite get there, but it's angels dancing on the head of a pin. If the market thinks you're there, you're there. The only question is, where are you? As Claudia was saying to Tom Keene this morning, we're not in a good place, but it doesn't necessarily mean we're in recession.
Jay Powell reminded us on the press conference a lot of data points before we get to September. Anna, come on in. I want to bring in Anna and Ira. Anna, you first. Is this a reported game changer in any way to you, and factor into your outlook on the U.S. economy, be it better or worse?
Yeah, so we have been forecasting that the unemployment rate should rise to 4.5% by the end of this year for a long time now. And I think this report just is just right on schedule according to our forecast. And the reason why we think it will be rising to that level, which is higher than most Wall Street forecasts, is that we have seen a cooling in the labor market that had been pretty meaningful since the middle of last year. So while the rise in unemployment rate in recent months may have caught the Fed, who had been actually forecasting for the unemployment rate to decline in the second half of this year, while they might be surprised, I think that if one believes that this cooling had actually begun in the middle of last year, then you would think, well, it's already been cooling for a year. In fact, it just has reached that nonlinear point where the Fed can't stop it anymore. So I think the Fed is behind the curve.
All right. Rates. Well, then let's get to you, Ira, and forgive us, Mike and Anna, because I feel like we're burying the lead a little bit. The rally in what we've been seeing in the U.S. Treasury trade, getting another boost today. Ira, today's trade, walk us through it. That 10-year, going to 3.78 or so?
Really bounced right off a very important technical level, right at that number, I would mind you, something that we highlighted about a month ago.
So what do we do? I mean, you know, we talked with you yesterday. You anticipate that the 10-year could go even lower. So what is the trade telling us today? Is it just a continuation of your think or something more?
Well, I'm thinking about taking vacation the rest of the year. We put out this morning a 382 forecast on the 10-year, so we're right there. So I'm done. I think the markets probably got a little overvalued here. And if you look at some of the technical indicators, at least in the short term, we'll probably get momentum in this kind of trade won't continue at this pace going forward. But I think the important thing is, like you noted, the 2-year note, rallying 25 basis points. It's been pretty volatile the last couple of hours as everyone's taken off the desks to go to the beach this weekend, and they you look at the steepening of the yield curve, and that's completely expected in a situation where the Federal Reserve is going to cut interest rates, maybe not more than they anticipated, than the market had been anticipating, but certainly faster. And I think that's where we're going. Now you have banks coming out and even the market pricing for a high probability of a 50 basis point cut in September. I'd be curious to hear Anna's view on that, because Anna and I talked yesterday on a podcast, and things have changed now since then. So I'm curious if we hear that. But that's why you have this big rally in the front end. I do think that we'll continue to see bull steepening of the yield curve. 2-year notes will be down, under 4% in a hurry. I mean, they're very close to that. And and I think that we keep going down to 3.5 on 2-year note. 10 years probably lag that, and that's where you get that steepening.
All right, so Anna, give us 30 seconds in response to what we just got from Ira, because we have Claudia Sahm here too, and we want to bring her in.
Yeah, so I think that Powell said very clearly that 50 bips is not on the table, but however, given today's data, I think they will indeed talk about it. It's still not the baseline as the market has priced in.
All right, Claudia, come on in. Claudia Sahm is with us. She's had a busy day. I'm sure a lot of people reaching out. Chief Economist at New Century Advisors, founder of Sahm Consulting. We played a little snippet of your interview on surveillance with Tom Keene this morning, where he said, is this some rule in force at this moment? And you said it triggered. Yeah. Tell us your reaction to the jobs data and what it tells us right now.
This was a disappointing report. It may not be as bad as it looks, or maybe as the reaction is to it, but we have continued to see some slowing, now weakening in the labor market. We're still in a good place. It's just the direction we are pointed in, the direction of travel has been not in a good, we're not pointed in the right direction. So as I said with Tom Keene this morning, my read of the economy, looking broadly way beyond just the Sahm rule, is that the U.S. economy is not in a recession right now. We still see an expansion of economic activity, jobs created, some special factors going on right now relative to prior recession periods. And yet, the risk that we are pointed towards a recession, or we're in that kind of pre-recessionary weakening, those are really going up. And that's what we should, policymakers like the Fed should be stepping in and really thinking hard about. How can they short circuit those dynamics, which in the past do not end up in a good place?
Claudia, this is Mike. I got two quick questions. One on the Sahm rule, just so we can sort this out. Do you use 2 decimal places or 3 in doing the math?
Never in a million years did I dream others would be creating and writing. This was a very specific tool in a proposal to do stimulus if there's a recession. No, I look at the published unemployment rate, so just as it is, the 4.3%, and take a 3-month average of that. I want to smooth out bumps and wiggles, but I don't get fancy and, like do the calculation, 3 decimal places, all that. I take the 3-month moving average and then take that series and look in the prior 12 months, so not including the current month, the prior 12 months, and find the low point, compare it if it's a 0.5 percentage point or more. In the past, in U.S. history, that has occurred early in recessions. This isn't a forecast. On average, it's about 3 months into a recession is when the Sahm rule triggers. There's nothing magical about the formula or the cutoff. It was me looking at the historical record saying, when could we say with a very high degree of certainty, not perfect, but a high degree of certainty, that, hey, we're in the early stages of recession. It's time to get, say, fiscal relief out. That's, it was all with that purpose and not thinking about, today per se. And it's not a way to call a recession.
Ira,
right?
you want to...
Oh, go ahead. Sorry.
Come on in, Ira. So I have a question. So you said about a fiscal response to a weakening economy. Given that deficits are still going to be running close to $2 trillion, how concerned are you that there might not be a fiscal response going forward if the economy does get meaningfully weaker? Obviously, the Federal Reserve can ease monetary policy, but fiscal policy might be more difficult to get in the next downturn.
Right. So in the context of where the Sahm rule and the proposal came from, it was from early 2019. So I have certainly learned a lot as a policy advisor through the COVID pandemic. And the big thing the Sahm rule falls down on is the taking into account changes in supply. And in its case, specifically labor supply, the labor force. And to your question about a fiscal response right now, because we are still in the last stages of fighting inflation, I would not endorse my 2019 proposal of broadly sending out stimulus checks. Even if I thought right now we were in that recession, it'd be more targeted, it'd be really, thinking about the inflation environment as well. So there is a cautionary aspect of thinking about the policy, but it does put the conversation out there. And to your point about fiscal space, though, if we were to get to a recession, if we were to get to a serious place, we have the fiscal space to respond. Whether we have the political will and kind of get it all together to respond, that might be a different question. And yet, really, the whole thing about this proposal, the stabilizers, is to let's have conversations outside of time of crisis about how to do fiscal policy as well as possible, knowing that we'll need it.
Anna Wong, I want to bring you back in here and talk a little bit about what Claudia said regarding labor supply, because I'm curious about, based on the numbers that we got this morning, how your view on the job market's ability to absorb more labor has changed in just a few months.
Yeah, one of Claudia's view is that, we're not sure whether this time what happened to the unemployment rate after the Sahm rule's trigger will happen again, which is that it should continuously rise for another 1.9 to 2 percentage point. So Claudia, this is as much as a question to Claudia herself. We have been looking at immigration and the absorption rate of these immigrants into the labor market, and we did note from the microdata from CPS that the unemployment rate for new immigrants are rising very fast. They're currently at 11%. And so I guess I'm wondering if the economy does lose this ability to quickly absorb these immigrants, would you still think that the Sahm rule would be consistent with the historical pattern where it would continuously rise for another 1.9 to 2%?
So the labor supply, both the immigration that we have now that's pushing up the labor supply and at least temporarily, or at this time, pushing up the unemployment rate, that is causing the unemployment rate to be higher. I think the labor shortages previously had pushed down the unemployment rate, notably, right, not sustainably. So, the Sahm rule again is all about these changes. So I think there's my take of where it's at with the increased unemployment rate is it's probably overstating the recessionary dynamics. So we've got these supply dynamics that are it's a whole other topic. And yet under the hood, there still is a weakening in the labor force, a weakening for demand for workers, right? And to your point, that's the piece that if it gets momentum and it keeps going, that's the recessionary dynamic. It's absolutely, if it's really just a matter of we had a bunch of workers come in, the immigrants come in a big group, and it takes time to absorb them. As long as you have a strong labor market, they do get they get jobs, unemployment rate trends back down, but that does require the labor market to be in a good place. So I think that's the question we don't know yet. Has that, how bad is that negative momentum? And that's why I said today's report was not encouraging. That it's not, I don't think you see a lot of improvement.
Let me put a question to Ira and Claudia, if you want to jump in on it as well. As I was saying at the top of the show, if we had ratcheted down to 114,000 jobs and slowly gone up to 4.3%, the Fed probably would be happy. So is it, what's causing the market panic, Ira? The fact that we move so quickly, or the levels that we're at? Because it doesn't seem the levels that we're at are, as we've been saying, recessionary or terrible.
Yeah, if it was 2016 and we had 114,000 jobs, you'd be like, okay, yeah, that's fine. But I do think it is the momentum and pace, and also this repricing of the risk, right? Because there are a lot of market participants who are worried that inflation might reaccelerate. We might have protectionist policies in the from the White House, and if things like that occur and we wind up with higher inflation, that maybe the Fed won't be able to cut as much. And I think basically that upward tail risk on inflation is coming off because of some of the data you have. Because remember, we're focused on this 114. The household data was actually a little bit better today than it had been, say, on a 6-month basis. But we had the labor force participation went up. We also had wages were disappointed to the downside too. And I think that those wage numbers, when you look at aggregate income, that is slowing pretty significantly. And I think that there's a lot of people who are looking at those type of data. You look at the market move today, you look at not only is our rates rallying and real rates rallying a little bit on the idea that the Fed's going to cut, but you also have break even. So inflation expectations have come down. You look at inflation expectations haven't been at 2% for 5-year inflation break evens in forever, it seems, right? Now, it wasn't forever, but it's been years since we've been at these kind of levels. And so I think that's pretty telling too, just the market saying, okay, inflationary risk probably off the table for now.
Claudia, I mean, if you look at the market reaction and you look at the inflation expectations, et cetera, is there any reason for Wall Street to be calling for 2 50 basis point cuts in a row or an intermediate cut?
So the market reaction today, this is a big reaction. So my read of where the economy is, how to interpret, the guts of this report, I don't see it as that negative. I have a hard time with the break evens, the inflation expectations. Those are really big moves for again, it was a disappointing release. There have been a string. I think it absolutely is the direction. It's the momentum, right? What stops this train, right? And it could still be in a good place if we stop kind of close to here. But that's just, this has been a very difficult cycle. There's been a lot of uncertainty. This comes not 2 days after we have Jay Powell and the Fed tell us we don't want to see any more weakening in the labor market. Mm-hmm.
Yeah.
We're not seeing it. And then we get it. I think it's just been a lot to process. So I don't think this is I think this is one day. This has been a really wild ride. I'm not updating my expectations on what the Fed does off of just today. And I think we can all just take a deep breath.
We are running out of time, but I do want to get final thoughts from everybody in our roundtable. Anna Wong, I want to start with you and just give us very briefly your thoughts on the implications of this weaker than expected data.
Yeah, so I think that it's not as suddenly that the labor market deteriorated. We have been documenting that this cooling has been happening for a while. I think that looking at 12-month unemployment flows, today's figure suggests 21% increase relative to 12 months ago. That's really sharp deterioration. So I think that the Fed is behind the curve.
Behind the curve. Elizabeth Warren agrees with you. She says, Jay Powell, get off your vacation, basically. Cancel it. Ira, Jersey, 30 seconds for you.
Yeah, we're focused next week on more like supply, and I do think that this is probably a little overdone, so we'll give back some of this rally in treasuries, I think, over the next couple of days, and everyone will reevaluate after we get the CPI report and retail sales.
Mike?
We look through to all these other data points, and I thank the Fed and the economy for once again driving up the ratings for us when we go to Jackson Hole and Jay Powell speaks.
Thank you. Claudia, 20 seconds for you. Any final thoughts?
Yeah, I think we're going to get past today. We're going to learn a lot more next week about the economy. I think this will underscore it's been a bumpy ride. We are still, all is not lost here, right? Like, I think there's still a path to the soft landing, and we are on it. It's just adjustments need to be made. The Fed needs to make some adjustments.
All right. Unbelievable. You guys, thank you so much. Anna Wong, Chief U.S. Economist at Bloomberg Economics out there in D.C. Michael McKee right here in studio, our Bloomberg News International Economics and Policy Correspondent. And Ira Jersey, our Bloomberg Intelligence Chief U.S. Rate Strategist out there at BI headquarters in Princeton, New Jersey. And Claudia Sahm, of course, joining us as well. Read more, too, about her Sahm rule and how we're looking at it when it comes to today's jobs report. You can find it at Bloomberg.com.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Bitcoin down 3%. It was down as much as 3.5% earlier in the session. Ether down today at 1 point, more than 5%. So a good day to check in with Michael Anderson, the co-founder of Framework Ventures. It's a VC firm focused on the blockchain industry. Framework Ventures investments include Chainlink, Synthetics, The Graph, and dozens of other companies. Michael joins us from San Francisco. Michael, how are you?
Doing well, thanks. Thanks for having me.
Yeah, good to have you with us. The ups and downs of the crypto industry, it's certainly volatile. I'm wondering, as a venture capitalist, what you're seeing out there in the space and how you could describe the landscape to us right now.
Yeah, well, our approach at Framework is that we're finding and backing the best founders in the space. We don't have to live with much of the market vicissitudes because of that. We're early stage investors. But I think if I was to have one kind of soundbite for 2024, I think 2024 represents the time of institutional adoption for crypto. We saw this with the Bitcoin ETF getting launched in January, most successful Bitcoin launch of the 11 providers. We just saw 2 weeks ago the Ethereum spot ETF launch. It's on track to do extremely well as well and bypass all expectations. And so we think the rest of the year, the first half of the year, maybe it was all about Bitcoin. I think the rest of the year is going to be all about Ethereum.
And over the weekend, we saw the former president and current Republican nominee for the White House, Donald Trump, go to the Bitcoin conference and profess his love for the cryptocurrency. Michael, does it matter to you who wins the election in November?
So it's a great question. What we know is that the Republican side of the campaign right now is very pro-crypto. They have been coming to events. They have been talking about it. It's part of the platform of the Republican Party. What we are waiting to see is what the Democratic Party will put together as part of their platform. So it's a bit of a wait and see program right now in terms of whether or not this technology can become bipartisan. But that's the goal. We want this to be a bipartisan effort so that it doesn't really matter who gets elected in November for this industry to continue to flourish. What we're really waiting for and what the entire industry has been hoping for is a playbook for entrepreneurship to come back to the United States. What we've seen over the last few years is without a clear set of rules and guidelines, entrepreneurs are moving outside the US and starting their companies in Western Europe or in Asia because there are playbooks and regulatory frameworks over there. We would love to see that come back, and that's hopefully what a bipartisan effort would bring.
Michael, I'm interested in your thoughts on Gary Gensler because President Trump pledged to fire Gary Gensler over the weekend if he does become president again. And it's interesting to hear that and hear that Gary Gensler has been the target of so much ire from the crypto industry, given that two pivotal things you just mentioned a few minutes ago, the launch of the spot Bitcoin ETFs and the launch of the spot Ethereum ETFs happened under his watch. How do you view him, and do you think he's as much of a lightning rod as other folks in the industry do?
Well, so on the first point, I think the catalyst for the Bitcoin ETF launching in January had to do more so with the finding against Grayscale, which favored Grayscale in that decision. And frankly, when we think about what the future of the SEC could provide for the industry, is there are a lot of great ideas. Hester Peirce is one of the commissioners who's put forward a concept of a safe harbor for entrepreneurs to be able to have a couple of years to build and develop their product or service and not have to worry about a regulatory overhaul changing the direction of whatever it is that the entrepreneurs are working on. And ultimately, that's what we want to see. We want to be able to have some period of time, a safeguard period of time, or a playbook so that people actually know what to do. And I think that there are a lot of great ideas at the SEC. We would just love to see them come to fruition.
Hey, one thing I'm really interested in, Michael, is zombie chains, because I feel like when all of this was starting years ago, a lot of people, I think, blockchains made a lot more sense. But tell us what's going on and kind of where we are in this, development cycle or developmental cycle when it comes to the use of blockchains.
Yeah, and I think this is sort of the dichotomy between, let's say, Bitcoin and Ethereum. Ethereum you can think of as maybe one of the app stores for these different applications, one of the app stores for finance, and there's a number of others. Just this week, actually, the California DMV announced that they were going to be working on a tokenization of all driver's license in California, 42 million driver's licenses built on top of the Avalanche blockchain. These types of applications are happening broadly. You could consider them tokenization or stable coins, or even games. At Framework, we've been investing in the gaming ecosystem for the last 3 years. And a lot of these games, some of these games are hitting multiple millions of monthly actives right now. And the application development is happening, and the growth is definitely happening as well. There are a lot of these platforms, whether it be ETH or any of the other layer one blockchains that are working, but there are some that haven't been able to hit that application success. And maybe those are considered zombie chains, but I think the ones that are working are becoming very obvious.
Wait, so are you telling us that we're not going to have to go to the DMV one day and sit in line for hours, and people I know it's a tough
Carol,
job.
You got to have your people go to the DMV for you.
No, you don't. You have to get a picture. You actually have to show ID.
I know you do. It's really
Tim
bad.
lives a really sweet life, a charmed life.
I'm the only person who's ever been to the DMV on my behalf, unfortunately. I have the stories to prove it. Don't forget a pencil or a pen at the Brooklyn DMV.
How many forms of IDs?
Yeah,
and the points?
Do not forget a pen. Let me tell you that.
Michael, what I am curious about, Tim has had numerous conversations, both of us have, over the years. How are you thinking about, especially as an investor, and thinking about kind of the startups in this space, how the interest and, the companies in crypto or blockchain that make sense, that it's where the money is going, and maybe how that has changed over the years?
I think a lot of the original ideas of blockchains are continuing to be the ones that are working, and we're continuing to see the success of them. And what I mean by these is, at one point in time, it was maybe called DeFi. I think the way that DeFi is maturing is really just tokenization. And tokenization is something that Larry Fink is talking about, on Bloomberg itself. Those types of opportunities for maybe the tokenization of all assets is something that we think is over the next 10 years, 20 years is absolutely going to happen. I mentioned games. Games is another category that we're really excited about.
What does the tokenization of all assets really mean? Help me understand that.
Yeah, so I think we could think about it in terms of driver's licenses. We could think about it in terms of equities. We could think about it in terms of bespoke credit swaps that may be traded or transacted. All of these assets, in the same way that we had the electrification of markets, we think that there will be the tokenization of markets, which provide more transparency, cut down on costs, and are really just infrastructure that makes these markets more accessible and available.
So does that mean we won't need a lot of Wall Street firms? Or all these trading firms?
I think Wall Street will adopt this technology in the same way that they adopted the internet and electronic trading mechanisms.
Hey, Michael, as a VC, what's exciting to you right now? What's the stuff that people are coming to you with? What's your staff going out and finding that makes you want to spend money on it?
There's a lot of things. For fear of running right into sort of the market narrative zeitgeist of traditional Silicon Valley, some of the obvious or really interesting things that are happening right now are the intersection of AI and crypto. And what I mean by this is it's pretty obvious that when we're talking about AI agents that are working in, consuming consumer computer services, they're not going to be able to start a Wells Fargo account or a PayPal account. They're going to transact with money on blockchains. They also need ample amounts of data to be able to train models or use the data for inference. The ways that data will be transacted will also happen on a blockchain. There will be a lot of overlap in the things that we're seeing with OpenAI or Llama and how those models are proliferated and delivered to customers, and blockchains will be an underpinning element of that for sure.
You ready for the tokenization of all assets?
Hey, I'm ready to not go to the DMV. that's like, and I'm ready to stop paying title insurance.
I know.
That would be nice to not pay anymore.
There's some things that would make so much sense.
There's a lot that would make sense. Michael Anderson, appreciate you coming on. Come back and hang out with us soon. He's the co-founder of Framework Ventures. It's a VC firm focused on the blockchain industry, joining us from San Francisco.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Sell-up in stocks intensifying. Bond yields plunging after a weak jobs report fueled worries that the Fed's hold stance on rates is now risking a more pronounced economic slowdown. Equities tumbled. A plunge in key tech companies sent the NASDAQ 100 down 10% from its peak, matching the definition of a correction. You just heard Charlie play some sound from Chicago Fed President Austin Goolsbee. Here's another bit of sound where he spoke exclusively to Bloomberg's Mike McKee earlier today.
We'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way.
There you have it, Chicago Fed President Austin Goolsbee speaking exclusively with Bloomberg's Mike McKee earlier today. We've got a great voice to help us understand the macro environment. Torsten Slok is back with us. He's chief economist and partner at Apollo Global Management, joining us now from New York City. Torsten, when we spoke to you back in March, you said you didn't see the Fed cutting rates this year. Based on today's payrolls report, other data that you've seen since then, have you changed your mind?
Yeah, we changed our view today, and that was on the back of, very importantly, Jay Powell on Wednesday signaling that we are likely to get a rate cut in September. We still have had fairly strong data with GDP growth in the second quarter at 2.8. We had retail sales for June at very strong levels. We'll get new numbers for that for July next week. We'll also get CPI inflation next week. But importantly, if you look at the high frequency data for daily data for how many people fly in airplanes is still strong. How many people go to restaurants is still strong. If you look at the IRS tax withholding data, it's also strong. Weekly data for retail sales is strong. Hotel bookings are still strong. Across the board, the weekly and daily indicators are still signaling that things are fine. So the bottom line is, yes, with this employment report, things are a little bit weaker, and it does fall in line with what Jay Powell was saying on Wednesday. So that's why we do think that we will now get a cut from the Fed of 25 basis points in September.
So what I'm hearing from you is that the sky is not falling by any means, Torsten.
Exactly. So let's just take a step back. And this is really, really important. And you and Carol have talked a lot about this. Namely, what is the reason why we should have a recession now? What should be the source? It's not like in 2008 where we had a major bank fail. It's not like in 2000 where we had a major bubble pop in the stock market. It's not like in 91 where commercial real estate was falling significantly. There is no major shock anywhere when you look at the data that is falling apart and therefore can justify why we should see a dramatic slowdown in the economy. So looking about the anatomy of what is a recession, if it normally is either an asset bubble popping, it could be some shock from the outside. It could also traditionally be that the Fed has raised rates too much, well, if its rates had been raised too much by the Fed, then the Fed can just begin to cut rates. So that's why this whole idea that suddenly from Thursday to Friday, meaning from yesterday to today, that we've had a dramatic change in the economic outlook, I just don't see the justification for that. I still think that we have a soft landing and the market is overreacting to one data point, which, by the way, could also be driven by a hurricane. There's still a lot of debate about that, as you know, today.
Yep, could be a slow your roll moment kind of thing. Having said that, former president of New York Fed Bill Dudley wrote a Bloomberg Opinion column last week. He said he changed his mind that the Fed needed to cut rates now. This was before the decision this week. Democratic Senator Elizabeth Warren, who is on the Senate Banking and Finance Committee on X today, said Fed Chair Powell made a serious mistake not cutting interest rates. He's been warned over and over again that waiting too long risks driving the economy into a ditch. The jobs data is flashing red. Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks. Is she right? So I'm assuming, based on what you just said, we don't need an emergency cut. There are GFCs and global pandemics, and then there is just another month of data in a trend line that has been showing a softening jobs market, right?
I think that's exactly right. Absolutely, Carol. I think that this is the trend line of the Fed started raising rates in March of 2022. Think about it. That's almost 2.5 years ago. And now we're beginning to talk about, whoa, this is the impact of the Fed raising rates. Okay, if that's the case, well, then, of course, we will likely have the Fed now beginning to cut in September, beginning to signal that they will continue to cut rates as much as needed. But there is plenty of room for them with the Fed funds rate at around 5.5%, still being able to cut if there is a need to get some support to the economy. So I still think, in particular, looking at, Jay Powell said on Wednesday, at the totality of the data, that yes, there is some weakness in the labor market here. Again, there's a lot of debate about how much of the increase in the unemployment rate is because of, again, weather, how much of it is because of immigration. Are there some special reasons for that? And I think that the Fed is saying, let's take some time here and figure out whether this is something that is more pronounced. If retail sales really weaken next week, that's not what we've seen in the weekly data, that's not what you're seeing in the daily data, then of course we can begin to think about whether this is a more likely scenario. But this idea that sentiment in the economy has changed overnight, the way it did with COVID, we did, as you said, Carol, the way it did with GFC, is just not what's happening in this situation here. It is much more a slow grind. So it is slower, but not crashing.
Hey, I do have one question though, Torsten. Do you have any regrets in your call of saying no rate cuts this year?
No, I think this was the right call in the beginning of the year. I mean, think about the roller coaster ride that we've had in rates markets. So for futures, as you know, which tells you something about what we will have in terms of cuts over the next several quarters. They were predicting 6-7 cuts at the beginning of the year. And that's when we began to say, no, this is just not what the data is saying. So I think it's a very similar situation today. Markets are really getting ahead of themselves, thinking, oh, gee, I want to be the one that predicts that the slowdown is here. I definitely don't want to be the one who didn't predict that the slowdown was here. And I think that the market is not looking at the data that's coming in, and the incoming data continues to be reasonably strong. Sure, it could change, but for now, it still looks like the economy is actually in quite good shape. Just think about it. GDP in the second quarter was 2.8. And if you look at Atlanta Fed GDP now for this quarter is now 2.5. Potential growth in the US is 2. We are above 2 by all measures of where GDP is at the moment. So the conclusion is it could be that if the stock market really starts going down, that we could change sentiment. But that's just not what the incoming data is showing.
Hey, Torsten, we love it when you join us on Bloomberg Businessweek. Our audience loves it too. I'm getting a message from a listener, a viewer, who wants to know what your valuation view is across asset classes. How do you position going into the end of the year?
Yeah, this is a very important discussion. So the very simple observation is, of course, that interest rates are still high. If you compare that where the Fed tells us where interest rates will be over the next several years, that they will be lower. So by that, it is telling you that if interest rates are higher than where they normally would be and where they will be over the next several years, well, then you should conclude, both in equities and in credit, that you should be up in quality. That's why in private credit, if you're first lien, senior secured, top of the capital structure, you get that protection against that risk of a recession being a higher likelihood. So that's another way of saying invest in companies that have earnings. And I know this sounds a little bit funny. Well, of course, I would invest in companies that have earnings, but that's not obvious at all. For example, in venture capital, you invest by definition in firms that have no earnings. So firms need to have higher coverage ratios, meaning have higher earnings that they can pay for those continued higher interest expenses. That means stay away from enterprise software, stay away from life sciences. Generally speaking, also weaker outlook for tech growth. Some parts of healthcare, some parts of consumer, areas where businesses have no earnings will continue to struggle, because the bottom line in that discussion is in the Russell 2000, 40% of companies have negative earnings. That's, of course, not good if interest rates, expenses continue to remain elevated.
Torsten Slok, look forward to your next research report and the weekend reading that you always share with us. Torsten Slok, he is chief economist and partner over at Apollo Global Management, joining us there in New York City.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, you know what we like to do. TikTok, everybody. 18 minutes left to go in today's trading session. Getting ready to wrap up the day and the week. And, yep. Equities, across the board kind of lower here, but I should point out that we are definitely off our lows of the session. I always like to add some perspective. It'll be interesting to see what happens as we get closer to the closing bell. However, almost 400 names in the S&P 500 are lower in today's session, 110 or higher.
I feel bad for anyone who has to come up with 3 or 4 gainers today.
That would be me.
Yeah, you find them?
Do you know what's the number one gainer in the S&P 500? You probably use the products. Maybe you don't, because I don't know. Everybody's been pushing back against bleach.
Clorox?
Number one gainer in the S&P 500.
Okay,
happens to be a gainer.
Look, perspective, we're up 11.6% on the S&P 500
You know what the number one decliner is, which was
Intel.
Easy for you. Yeah,
that's going to be my first decliner. I want to see what Andrew Krei has to say about today's market action. He's co-chief investment officer at Crescent Grove Advisors. They've got about $4.7 billion in assets under management. Andrew joins us from Milwaukee. Andrew, you getting a lot of calls today from clients at all who are concerned?
Fortunately, no calls today. So either they're well-trained.
I was going to say they're trained well. That's exactly what I was going to say.
Or, they I think have a similar take to us, which is, let's think about signal versus noise here. Is this real signal in terms of, is this jobs report really suggesting that we're heading towards a full-blown recessionary scenario, which seems to be what we're pricing in at this point? I mean, this sort of magnitude of the move that we're seeing within fixed income, within, short-term rates markets is just really dramatic relative to what we think is sort of the broader context of economic data. So, perhaps, again, we would sort of make the distinction between signal and noise in this environment.
So you think the weaker than expected payrolls report that came this morning and the revisions that we saw to last month, revisions lower, you think that's more noise than signal?
You have to, look, you have to take it at face value for sure. There's clearly been a weakening within the labor market. There's no doubt about that. But I think, one of the things, I think the San Francisco Fed had pointed to this, others have pointed to this research, talking about the immigration sort of effect on the unemployment rate, and talk about the Sahm rule and all those sorts of things that would be triggered, where we've seen the unemployment rate tick up. We think you have to take, again, the whole context of what we've seen within the labor market, and you look at the other measures as well, whether that's ADP, whether that's challenger job cuts, whether that's JOLTS data, all these sorts of things. The overall mosaic, initial claims, ongoing claims as a percentage of the labor force, all these sorts of things suggest to us that we're just cooling off of a extremely hot level. So I don't know that this dramatic of a response is warranted in this case.
So Amazon's down almost 10%. Intel is down about 27%, just picking two names on the decline today. If things aren't as bad, Andrew, and I could certainly talk about some of the other decliners in today's session, does that mean that this is a buying opportunity, at least when it comes to the equity universe?
Well, so we would, I think, take tech on the one hand versus everything else on the other hand is kind of how we've been looking at it. And in so much as I think tech has just traded at a too rich of a premium relative to the rest of the market. Now, it was warranted as you go back and look at the earnings growth differential that we saw 12, 18 months ago. But as we approach the second half of this year and into Q4, where this earning growth differential starts to converge between, the Magnificent Seven, let's say, sort of take those as the poster children for the tech rally relative to S&P 493, the rest. I think you start to see that earnings growth converge. That's where I think there's the opportunity for sort of a rotational trade. So we wouldn't be necessarily as all in on some of those tech leaders that perhaps have seen a little bit of weakness, but we'd be thinking more about how can we rotate into some things where the bar has just been set a little bit lower going forward.
How does it look going forward from here? If you're seeing people out there today buying because they see this as a buying opportunity, and look, we are off our worst levels of the day. Do you advise, and look, you can't time the market, but if you're thinking, or so I'm told, I'm not saying you can or can't.
Yeah.
If you're looking out ahead, do you see this as a buying opportunity, or do you think people should sort of sit back and wait for the dust to settle?
Yeah, I think longer term investors, right? We put on our allocator hat and we say, ultimately, you want to have an allocation to stocks. You want to take advantage of periods where there's weakness like this, to incrementally add to names, to exposures that you want to have in your portfolio. And right now, we think that tends to be more on kind of the value side of the equation, which could be some things that might be a little bit more pro-cyclical, but also a little bit more defensive in nature. That tends to be kind of the makeup of the value indices. And then even some folks that have been so home country biased, so heavy overweight to the U.S. and those big tech names, take a little bit of, an opportunity here to rotate into some non-U.S. names, perhaps. Let's look at EMX China. Let's look at Europe. Let's look at Japan, where the data hasn't been, setting the world on fire, but it's inflecting higher. And we think there's still an underpinning of global growth recovery at this point. Whether you look at export volumes, whether you look at sort of early indicators on PMIs, those sorts of things, to suggest that, again, from a relative value rotation perspective, that's where the opportunity is going to be over the next 6 to 12 months.
Yeah, Arjuna Martin Adams talking about, right, branching out in terms of the global equity universe and how Fed policy can certainly play into that. Where do you not want to be? And I'd love you to take us to the fixed income world, especially as we have watched quite a rally over the last couple of days, certainly since the Fed meeting. Where do you want to be when it comes to the U.S. Treasury curve?
Well, I think that you hit it with the rally that we've seen, and thinking about a fresh dollar going to work today in the fixed income market. I think we just want to fade this idea that we're going to get a dramatic amount of rate cuts over the next year plus, right? I mean, if you look at, I was looking at the SOFR futures curve going out to the end of 2025, end of next year, pricing in about a 3% Fed funds rate. We just don't think that we're going to see that magnitude of cuts from the Fed in that environment. Because we're going to see sticky inflation, we're going to see growth that's reasonably okay. You look at as a related aside, the Atlanta Fed GDP now still running in the mid twos. If you look at their PCE forecast and come up with a nominal GDP forecast, that's still around 5%. We just don't think that meaningful cuts to the tune of 200 plus basis points are warranted. So in that case, you want to favor some shorter duration instruments within fixed income, because we're not going to see the full realization of what's being priced in at this point.
How many rate cuts? Just 30 seconds. How many rate cuts do we have this year?
Well, I'll tell you, the market's pricing in nearly 5 by the end of this year.
What do you think?
We tend to think that, perhaps the Fed goes 50 if they want to, use the Jackson Hole meeting as sort of the forward guidance period for them to tee up, 50 in September. But I just tend to think that, they've been a little bit more incremental all along the way getting to this point. And I think they're still rightfully concerned about inflation being sticky.
Right.
So, 25 a meeting seems about right.
Andrew Krei, Co-Chief Investment Officer at Crescent Grove Advisors, joining us from Milwaukee.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.